Hey guys, hope everybody's doing well. Welcome back to another video. Just bear with me, I'm not really feeling well. I'm feeling under the weather. That's why I didn't have a Wednesday video. And I've been really busy actually lately, so I'm not sure. I might skip a couple Wednesday videos here, probably this month. I don't know. So you'll have to just forgive me if I sound ugly or whatever. If I look ugly, I probably look ugly anyway. But I hope everybody's in good spirits. I hope everybody is ready for this year to end. That doesn't sound optimistic, does it? But anyway, what I'm looking at today is a income fund that is very interesting. Pays 10% a distribution on the net asset value. It's a managed distribution closed-end fund with a high expense ratio, like all closed-end funds do, but this one does not use leverage and is quite interesting. And if you wait till the end, I'll give you my thoughts on how this high yield income investing is best handled, okay? Because a lot of times, well, just stay tuned. All right. So if you're new here, like, share, subscribe, do all that good stuff. Down below in the pinned comment down below is my Amazon link, Teespring link. Use that if you would, please. That has dropped off the map for me for some reason. I guess I didn't promote it as well the past few videos, but Amazon link is down there, Teespring link, referrals, all that good stuff. I'd appreciate it if you'd use those. So we'll just get into it here, and we are looking at today is the Liberty All-Star Equity Fund, and its ticker symbol USA. Excuse me. And it actually trades currently at about $6.67 a share. Now, the net asset value of the fund, if you don't know about closed-end funds, they trade separately from the net asset value of the fund. So if you look at all the value of the shares of the companies that the fund holds, it works out to $7.23 per share. But you can buy shares of the fund for $6.67. And if you look right there, that works out to a 7.75% discount to the value of all the fund's holdings. I hope that makes sense, because that's critical. Now, if we look at a 52-week average on this fund, it normally trades at a 5.86% discount to its net asset value. So you're getting a little bit better price than historical norms, or at least 52-week average norms. And you'll see at times where it will trade at a premium to the discount, or premium to the net asset value. And then there's at times the 52-week low, where you get a huge discount to the net asset value. And this one was at the time, I'm guessing it was around March 23rd of this year, you got a 21.29% discount to the net asset value of the fund. So if we look down here, this is a managed distribution, and I'll get to that when we look through the fact sheet. Has a 9.6% distribution rate, and it pays about 16 cents roughly, we'll get into that again, every quarter. Now, this fund has been around forever, and if you look at the since inception chart, it looks pretty bad. Okay, we'll go started at like $10-11, and now it's $6.67. Okay, but if you would have bought this back in 1995 and you reinvested all those dividends, you'd actually be up quite a bit, and we'll go over that towards the end. So what is the Liberty All-Star Equity Fund? Well, It is a closed-end fund, basically a mutual fund, and what they do is they split apart portions of the net asset value to 5 different fund managers. Okay, so they are basically a 60% value and 40% growth. Okay, and they split that up to these 5 different advisors. So the Fiduciary Management Inc. gets a slice of value, 20%. Pzena Investment Management, they get a slice of value. Aristotle Capital Management, they get a slice of value. TCW Investment Management gets a slice of the growth. And then Sustainable Growth Advisors gets the other 20% of the growth. So it's kind of complicated, but they get 20% of the fund assets, and they get to invest for the fund. It is considered a large cap core fund, and we'll go over its holdings here shortly. So if we look at the fund strategy, it's a multi-managed fund that allocates its portfolio assets on an approximately equal basis among several independent investment management organizations, currently 5, having different investment styles recommended and monitored by ALPS Advisors Inc., the fund's investment advisor. So here we are at the distribution policy. Now, when I said they had a managed distribution policy, this is what that means. The current policy is to pay distributions on its shares totaling approximately 10% of its net asset value per year, payable in 4 quarterly installments of 2.5% of the fund's net asset value at the close of the New York Stock Exchange on the Friday prior to each quarterly declaration date. So if we look at the net asset value, 7.23, if that stays there, if that stays 723 basically throughout the whole year, then they're looking at distributing 72 cents for that year. Does that make sense? So they're going to do 10% of the net asset value, and that's how they're going to manage that. And we'll look at the performance. I'll leave links down below to all this stuff. So if I go over all of this, it's going to be just an hour-long video. But here's the fact sheet, and we'll look at the sector breakdown. This is as of September 30th, 2020. These are not like ETFs where they have to disclose daily. They do basically quarterly earnings reports like companies do, like individual companies do. So as of September 30th, they're 22.7% in information technology, 15.4% in financials, 14.7% in healthcare, 14.3% in consumer discretionary, 12% in industrials, 6% in communications, 4.5% in materials, 4% in consumer staples, 3% in energy, 2.7% in real estate, and 0.5% in utilities. And their top 10 holdings as of September 30th are going to be well-known companies: Amazon, Adobe, PayPal, Visa, Facebook, Microsoft, Alphabet, Google, Salesforce, Danaher, and United Health. So, this is not, they don't shoot for the sky for high yield companies. What they basically do is trade to earn their money, right? To earn that 10% a year. So, well, it's not actually 10% a year, but they're trying to cover that distribution of 10% on their net asset value. And what I'll encourage you to do, I'll leave this down below, is the quarterly report. It's 24 pages long, and it tells you how they made their money, how was each investment advisor performed and all that stuff. So very interesting information in here. But what I wanted to talk about is the distribution. Like a lot of these, and I'll go to my favorite ETF channel. A lot of these income investments are great while you are reinvesting the distribution. But once you stop reinvesting the distribution, you become stagnant, and it's kind of dangerous waters, okay? Because you could end up, your income could fall, and it's not going to keep up with inflation, right? So what I suggest with all of these high income yield ETFs is to at least when you plan on living off the distributions, try to shoot to have at least a quarter of it be reinvested back into it. That way you're buying more shares, buying more income, and slowly increasing your income year after year, because normally with these income funds and ETFs, you're not going to get any dividend growth. So you are going to have to manufacture your own dividend growth off the distribution, right? And here is a perfect example of that with the USA fund. And we are going to compare this to the SPY, which is the S&P 500. And we're going to chart 10,000 invested in SPY and 10,000 invested in USA. And what you see here is a total return of SPY since 1995 with 10,000 invested has turned your 10,000 into $100,756. With a $10,000 investment in USA, even though that chart looked ugly that I showed you prior, right? It looked like just basically upper right to down, right? It looked ugly. Your $10,000 still turned into $71,675. That is because you reinvested the distribution. Now, if we look down here, I usually don't discuss this, but if you did not reinvest those dividends, look at the difference. Now on USA, you took all the distributions and your money's only grown to $25,892. Okay. And whereas in SPY, it grown to $77,000. So that's the big picture. So if you invested this in 1995, let's go to the calculator. Now you have 10,740 shares, right? We times that by, what was there? Let's say 64 cents, I believe was this year's distribution. You are getting paid $6,873.60 per year in income off of that $10,000 original investment. So this is how you've turned a horrible, essentially, investment into something positive. But you have to reinvest that dividend. Without it, you end up flat, like how it looks down here on the bottom. So that's all I have. Thanks for sticking with me. I might have just stumbled and bumbled because I'm not feeling good. So if you guys got any comments or anything, leave them down below. I'd appreciate it. Like, share, subscribe, do all that good stuff. And we'll talk to you later. Thanks. Bye-bye. I am not a financial advisor. The information contained in this video is for entertainment and informational purposes only. It is not intended to be investment advice. Please seek a licensed professional for any investment, tax, or legal advice. Thank you.